There has been like an outrage in the last few days about that family that got a huge tax bill from CRA, $660,000. When I see what the working class, when I see what small business owners do for the Canadian economy, I want to be there and protect them. I want to be there and ring the alarm and show people that the government doesn't have our best interests at heart.
My name is Rory Seawald, and today I'm here with Jose, and we're going to be having a great discussion.
Yes.
And just to give you a little bit of insight, me and my team, we specialize and help people, especially Canadian business owners, make sure that the CRA, the Canada Revenue Agency, does not become their state's biggest beneficiary. And we help these Canadian business owners in various ways, utilizing financial products and tools and strategies. And that's really the foundation and core of what we do here within the team. So I'm grateful to be here with you, Jose, and look forward to this conversation.
Great. I'm Jose Atencio. I'm the founder of Austeris Capital Advisors. We are Canada's premier association of freedom-minded financial advisors. Our goal is to show you what the government is doing to erode your financial freedom, erode everything that you have built so far on the financial side. Our goal is to show Canadians how they can break away from chains of financial dependence, how they can break away from the control that bankers and the banks institutions hold against them, and also how to make sure that everything they have built and they have worked for, that they get to keep when it comes to time to pass it on to the next generation. We make sure that you are financially protected. We make sure that all bases are covered. And we see the financial landscape and economical landscape from a different set of lenses than what most people are accustomed to.
Yeah. Very cool.
Yeah. So, Rory, there has been like an outrage in the last few days about that family that got a huge tax bill from CRA, $660,000. It hit close to home in my case because this is something that I think a lot about. When I see what the working class, when I see what small business owners do for the Canadian economy, I want to be there and protect them. I want to be there and ring the alarm and show people that the government doesn't have our best interest at heart, okay? And there is a lot of us with the knowledge to bring about a change, not only on the personal level, but like at the societal level. But everything starts with the individual. Everything starts with awareness, I would say. So, do you know about it?
Yes.
Can you comment about it?
Absolutely. And I too align with your thoughts and beliefs because there's a lot of people and a lot of families that struggle with this and that essentially gets thrown into this position where they don't know what's going on. Where is this tax bill coming from? They weren't expecting it. Their parents didn't expect it. Exactly. And it's unfortunate that it happens, but this is really why we got to make awareness, like you said, around tax and estate planning and making sure your affairs are in order so that we can make sure this doesn't happen unexpectedly. When there is going to be a tax bill, the next generation knows how much that bill is going to be and how they're going to pay for it. If it's going to be paid with cash, borrowed money, if they're going to sell properties, if so, which property, or have the proper life insurance to pay the tax bill.
Exactly. So for those of you that are not aware of what happened in this situation, it was this family, I think out of Ontario, right?
It was Ontario.
Yeah. Mom was a nurse. Dad, I think he was blue-collar worker. Like they worked their whole lives to create savings, to be able to retire one day. They had a cottage. They had a family. Essentially what happens is that dad passed away, and some months later, the wife also passed away, like his wife. Now, if that wasn't awful enough, they had $700,000 more or less RRSP, and out of the $700,000 RRSP, basically half of that RRSP was taxed. Just full stop. Just imagine that.
Yeah.
You're living your whole life. That family was probably 30, 35 years working towards those savings. And that was supposed to be their retirement fund. Now, the hope of a lot of parents is that everything that they have built, if they don't get to enjoy that, at least the kids will be able to enjoy that and they will be able to leave an inheritance. Now, the CRA came in and said, we have better plans for this. And they say it's tax. I call it confiscation. I call it theft, basically. And I think a lot of Canadians can agree with that, right?
A lot of Canadians align with that.
Right? They're like basically fed up with the situation. And this is just one of the many cases that happen every day. Every day. Like this kind of stuff, guys, like it's just that this one specifically got public, but this is the kind of stuff that happens every day. Like even more like business owners, still to this day, I have met business owners that think that they can just transfer the company to the next generation and nothing's going to happen.
Yeah, on and on, intergenerational business.
Right, exactly. So could you expand on, for example, the business owner that has built something?
Yeah.
And what happens once it's time to transfer that to the next generation?
Yeah. Essentially, at the end of the day, what we want to do is cover the taxes. If it's going to stay in the family and there's not an intention of selling, but also we got to keep in mind, you don't know when your expiration date is.
Correct.
So if you don't know, if you may pass away next week. So as a Canadian business owner, you've built this magnificent company. Maybe your intention is to sell it, Jose. Mm-hmm. But you die before you can.
Mm-hmm,
Who's going to pay the taxes?
Who's going to pay it?
Who's going to pay the taxes?
Where's that money going to come from? Because if you're listening to us and you're a Canadian business owner, like I know for sure that you are reinvesting everything that comes in, all the capital that comes in, you reinvest that into the company. So like the cash reserves are actually not that high for a $500,000 tax bill to just, you're going to be able to pay that right away. Like, where's that money going to come from? You're going to have to liquidate something, right? Yeah. And can your business afford a $500,000 hole? Maybe it can. Yeah. But for a lot of small business owners, that's devastating, right? Even more so for a family.
Yeah.
So.
And we talk about this philosophy that we'll dive deeper in here in this conversation, but utilizing insurance and how it can be leveraged and used to make sure that our assets are protected, our liabilities are protected, number one, but our assets are protected too.
Yes. And that's very, very important, right? It's not just that tax liability, but everything that you have built, how you are going to protect that, right? And those of us that are specialized in the risk management side of business, there's another part of us that is mostly managing like investments, growth.
To expand on that, if you don't mind, there's really two types of financial advisor. To really expand on that, there's really two types of financial advisors. Risk management, one focused on risk management, who understand growth, but they understand risk. And then there's growth financial advisors who sometimes they don't understand the risks and they don't understand the tax implications. You can, I often ask business owners, what is your desired average rate of return? And they'll just say something crazy, 12%, 15%.
Yeah,
I want 18% average rate of return. Great, we'll use that. And then we look at what that turns into. How big of an estate is that money going to turn into in 20, 30, 40 years? Yeah. You got an estate of $40 million. Right. How much is that tax bill? How are you going to pay? It's very simple.
Exactly. If something like that happens, but 12% rate of return, it's a ridiculous rate of return, but people think that this is actually a real deal. But then you need to take into account volatility, you need to take into account taxes, and then how much are you left with, right? Yeah. If you ever get to hit a 12% rate of return yearly. But that's a very interesting point where you're saying that there's a lot of us that are more on the investments and growth, and the other side is more on the risk. People don't know that.
No.
People don't know that. And
they say, I have a financial advisor.
And like a lot of those financial advisors that people interact with, they're just like there to make you sign a paper where you are putting X amount of money every month into a registered account and effectively making you a partner with the government. And I know that's controversial, and I'm going to expand on what that means. We have been told that the best place to put money to save up for retirement is the RRSP. Okay? The Registered Retirement Savings Plan.
Everyone says that.
Who created that? I ask you, who created that?
Of course, the government.
The Canadian government. So not only they create the problem, but they also give you the solution. And then we go and buy that. And we don't even ask questions. We just go and do it. And a lot of financial advisors are just helping the government when they do that. Do you think the financial advisor that was, well, potentially, I hope there was a financial advisor guiding this family? I don't think so. I would assume there was none, because something like this happened, right? Maybe they just went to the bank and they opened an RSP, and the bank will say yes, and they're just going to take
Sign
your
on
money.
the dotted line.
They're just going to
We'll get
take
you
their
set
money,
up.
right? And then what happens with that money once the bank has that money, right? Like that money is going to the RSP, but who really has access to that money? Who had access to the $700,000? Was it the family?
Nope.
No. Then who had access? Because that money existed, right? Somebody had access to that. And I will submit to the people listening, think about that. Once you commit yourself to put all your savings into this type of account with no real purpose, with no real goal, there's a place and time for an account like that.
Yeah.
But it's not a one-size-fits-all. Like, it's not for everybody, okay? There has to be some planning.
Absolutely. And to expand on that as well, I love this conversation, by the way. It's because we want to plan for the end. When you're planning for the end, what's the end? We're going to die. That's the end. We're going to die. That's guaranteed. Taxes and death. That's the two great guaranteed
Exactly.
things. So if we know that's going to happen, we might as well plan for it to reduce taxation, or if not, maybe even eliminate taxation from the estate.
Correct.
If it's going to happen anyway.
You mentioned estate. Can you explain to the audience what is an estate?
Yeah.
Just briefly.
Yeah, simple terms. An estate is something that you've built over the course of your life through working hard for every dollar. There's a lot of Canadians that work hard, long hours for their family to put food on the table. They're building their estate. They're building their portfolios. They're building their RSP accounts. They're building TFSA accounts. They're purchasing property, potentially multiple properties. And in that case, you and I both know the tax bill just gets larger and larger. The bigger the estate and the more money you have, the more problems you have.
Exactly. And people tend to think that money will just solve the problems. With money comes problems. And it is actually easier to make a ton of money than to keep a ton of money. It's an easier thing. And
especially with CRA.
Exactly. And you see that time and time again. Like, there's examples of that. Like, wealthy families, they get to build something, they get to build a sizable estate, and it doesn't survive 2 generations. It's gone. Because there's a lack of long-term vision on the financial advisors. It's like everybody is on this bandwagon of great returns. We're all making money in the market, but what happens when the show stops? And that show can be stopped at any time. It can be death, or it can be a financial crash, like a market crash. Right? And I don't know about you, but do you usually meet advisors that talk about that?
Not a lot. Not enough.
Exactly.
Not enough.
Exactly.
They're so focused on the growth, which is very important. We're not discrediting, obviously.
Correct.
Have your investments grow. But what we're saying is we got to look long term.
Yes.
Not just on the growth, because you can build this beautiful estate worth millions and lose it all.
Yeah, exactly.
Great example here.
And that planning is, I always say this, you have to have strong foundations. Okay? The same with a builder. When you build a house, you need to have strong foundations. That's one of the most important parts of a house, right? Is those foundations. Now, How do you properly translate financial foundations in financial terms?
I personally use whatever building we're in, and I'm sitting down with the clients. I use this building often. Is like this building has a strong foundation. When a big storm comes and big tornado, depending on the size, it's not going to disrupt the building. The building is going to stay standing and strong. It's got strong roots, strong foundation. That's insurance. That's tax and estate planning.
Exactly.
And it's got to be the right insurance too.
And that's interesting. Are we talking the type of insurance that people usually say, oh, give me the cheapest insurance, right?
Yeah.
Again, there's a time and a place for that. But if you are a business owner, if you have families that also depend upon that business, because that's a huge responsibility also for a business owner. Like, it's not only providing for his family, but he has other families that depend upon that business.
Absolutely.
How do we protect that?
70% of small businesses here in Canada have 20 or less employees. So
Yes.
that's 20 employees with families.
Yes.
You're providing
Yes.
more
And
than
you
just
said-
20
And
employees.
you said 70%. So we're talking like the bulk of the Canadian economy, it's driven by the small business owner.
Yeah. It's driven by the people listening to this.
Exactly.
And that's why they're so concerned with
Exactly.
hearing the story here recently in Ontario. That's why a lot of people are going to be interested in learning about how can we make sure that doesn't happen to my family.
Correct. But before we go into that, we didn't touch really upon the details of what happened there. It was $660,000 tax bill. It was an RSP that was worth $700,000. Now, when dad passed away, the spouse got a spousal rollover. Spousal rollover, it's basically what happens is that every investments that the couple has, once one of them passes away, everything goes rollovers into the other spouse, and there's no taxes. There's no tax bill in that case. So that happened. So dad passed away. Everything that was under dad's name now going to the mom's name.
At the start of the year.
Correct. And then they don't have to pay any taxes of that. What happens is that once the second spouse passes away, then everything becomes taxable there. And this is exactly what happened. Like that RRSP fund that was transferred to mom, it was taxable because they both died in the same year, basically. On top of that, there was this house, a cottage. Like the couple used to have two houses. They got rid of their primary residence and they moved into the cottage and declared that as the the primary residence now. But that cottage, the CRA brought up like a clawback clause where they are now asking for the taxes of that, the capital gains basically of that cottage.
And that's not new. That's been a rule and a regulation here in the tax regulations and
Yes.
laws for decades and decades.
Exactly.
It's just, if people aren't aware of it, they don't know about it, how are they
Yes.
supposed to know?
Yes. And this is usually something that you don't even hear from the CPAs, because people will think that the CPAs will be dealing with this, that they're usually so busy dealing with the numbers. Regularly, like the families that usually have access to this kind of advice are families that have access to tax lawyers or the top financial advisors in Canada. But this is the reason why we're making this video. Like, people need to understand that financial advisors like you and I are actually very accessible. And a lot of the times, we don't charge fees. Like, it's actually the insurance companies that we use to create the tools that are going to fix the problem to the business owner and to the family. They are the ones paying our bill. It's not the client. Can you expand a bit on that? Yeah.
Absolutely.
Yeah.
So similar to mortgage brokers or any kind of broker, this is what we do. We shop the market. We want to make sure we're providing the best value to our clients. And we do that working with multiple insurance companies, not just one.
Okay.
When you only work with one insurance company, you're limited to what you can offer your clients.
Yes. Yes.
Why would you want to work with a financial advisor
Yeah.
who can only sell you one company of one product?
Exactly. Or why would you call every single insurance company to try to get the best deal, for example? Because what kind of questions are you going to ask the insurance company to make sure that this is the right product for you? People don't even know those questions. This is what we do. We live and breathe this stuff, right? This is everything that we do. So
we love it. We
we love
this,
it.
by
Like
the
you
way.
guys can tell,
love
we
what
just
doing.
set up this call, this video to explain and talk to you all about this, right? So we are passionate about this stuff, right? And when something like that happens to me, as I mentioned before, it hits close to my heart because I can see my family there. I can see my friend's family there. I can see the small business owner providing income for 5 families, for example, right? And yeah, it's just an awful thing. But it's great that the tools do exist to mitigate that risk and make sure that the legacy that you guys are building, that legacy can be passed on into the next generation. So
That's the key.
yeah, that is the key.
We call it legacy planning, call it tax planning.
Exactly.
I love the term legacy planning.
Exactly. Exactly.
People and business owners especially, they've sacrificed so much, Jose, so much time, money, energy, sweat
Yeah.
into their baby, their business, and they don't even know they're exposed.
Exactly. No,
They're exposed to risk. I'm getting chills just saying it because it's so true.
yeah. No, and that's key because that's where we come in, get the big picture. And I won't say that we know everything, but we're just the front face. There's a team of highly skilled professionals that you guys don't see on camera. And these guys know more than us. We know the basics to know where to find the problems. We know the usual places where the problems are. We go there and expose them. And then we bring the professionals, the cleaning crew, to get rid of that can of worms. That is the people that we have behind us. And that's the team of professionals. Like, we have access to CPAs. We have access to tax lawyers. We have access to people with decades of experience in estate planning.
Yeah.
And it's just a matter of shooting us a quick message and it's done.
Yeah. It's very important that everyone is on the same page. Oftentimes I see the CPAs not on the same page as the insurance guys, they on the same page as the financial advisors, not on the same page as the lawyer.
Yeah.
And there's a lot of disconnect, and that's not good. You want connection, you want to be on the same page.
Correct.
Because you want to have a team. If it's just you and your financial advisor, or you and your accountant, or you and your lawyer, and nothing is connected, there's going to be miscommunication, and there's going to be holes in your boat that you don't even know about.
Correct. The type of financial advisor you're looking for is a financial advisor that can sit on a table and speak to the lawyer, speak to the CPA, speak to you, and everybody involved in the process of that estate plan. And not many do that. No.
That's where the ball is dropped.
Exactly.
And this is when we hear stories like the one in Ontario.
Exactly.
Every single week.
Yes.
We hear them. You might not hear them.
No.
Because it's not in the news, but we hear them
Yes.
every single week. And it happens a lot. And that's why we're so passionate about what we do.
Exactly. Yes. Now, I want to briefly touch upon this book right here. This book right here is not here by chance. This is a big part of the value proposition of Austeris. We are teaching Canadians how to become their own bankers. And by becoming their own bankers, something like this estate taxes nightmares also are taken care of. And some of you might be thinking, okay, how does that happen? Basically, the infinite banking concept was the concept developed by R. Nelson Nash in the US back in the 80s. The whole premise of the concept is we show you and we create a privatized banking system where you recapture the interest that you will either pay a financial institution or pay yourself out of the opportunity cost of paying cash. We often say that there's two types of people in the world. Those that pay cash for everything, like your Dave Ramsey types, right? And then you have those that take a loan for everything. We are proposing you to become part of a third group here, where by having access to capital and by building capital inside of specially designed insurance policies, not only you're taking care of your financial function, your banking function, you're not only taking care of the things that you have to finance in life, the things that you have to finance for your business, but that money is also growing tax-free inside of this account. It's going volatility-free because these types of accounts are not attached to market volatility. And the other thing that happens is that uninterrupted compounding. It has been said that uninterrupted compounding, it's one of the 8 wonders of the world. And that was a term coined by Albert Einstein, said that. Those who understand uninterrupted compounding, they are able to harness that. And those who don't end up paying that compounding to a financial institution. So people that, for example, finance everything through a bank, they end up paying that compound interest, but against them to the bank.
Yep.
So by us taking care of the banking function and building these specially designed policies, we are able not only to take care of that, but also that estate part, right?
Absolutely.
Because we're talking like permanent death benefit. It's permanent. So regardless of what age you graduate, that death benefit is going to be there to cover any potential tax liabilities.
And oftentimes we see still a lot of confusion between temporary coverage and permanent coverage.
Yes.
Some people think it's the same thing. It's not the same thing. It's not even close to the same contract. So you want to know what you have, and there's a certain way to do it. And I like to think, and this is just a fact, that life insurance is its own asset class.
Yes.
Life insurance is its own asset class. Real estate has an asset class.
I agree.
You have your TFSAs and investments and all of that.
Yes.
Life insurance is an asset class, like you said, that doesn't have market volatility. It's structured in a certain
The right type of
life
policy,
insurance
right?
policy.
Yes.
There's different types, obviously, and we just want to make sure that this is brought to the public and people are aware of this option where.
Yeah, and people have to be aware that there's other places where to put and park your money, and they don't have to be a bank. People don't know that. It's amazing. Like when I tell people that they can actually save inside of an insurance policy, a lot of people don't know that. A lot of people don't. When I tell people that I can help build a warehouse of wealth inside of a specially structured insurance policy, they don't know that. But what a wonderful thing it is to know that your capital is secured inside such a policy where whatever happens in the market, it doesn't touch you. Those are the foundations we're talking about. And those are the foundations of your financial life. When it comes a time to pay, you have been successful, you have built businesses, you have built a sizable estate. When it comes a time to pay those taxes and leave an inheritance, the money's gonna be there. And this is exactly what that family needed.
Absolutely.
That's what I think. Like this is exactly what that family needed to have. And they didn't have it. They didn't have it because that education is not out there.
Yeah. I believe there's or investments and investments.
This is an and.
And this is an and. But think of every other kind of investment. It's an or. It's real estate, or I invest in the stock market, or ETFs, or what do I do? Go buy gold. It's or. You can't use the dollar twice.
Correct.
So maybe we can dive deeper in how we can use the dollar more than once.
Oh,
how wealthy families use it. And we just want to say that there's a particular circumstance where this is applicable. I don't believe someone who has a low income should be dumping lots of money into a high cash value life insurance policy. You need to pay the bills. You need to make sure that your bases are covered. But we're talking to the people who have these sizable estates or planning to have these sizable estates, how can we turn the cash into cash value? How can we have a probable outcome versus a predictable outcome? What are the differences?
Exactly. Yeah, no, and that's what happens inside of this contract is that once you start building this asset, you mentioned that this is an asset. And the analogy I give to my clients is that when you buy a policy of this type, it is exactly like as if you were buying a piece of property. And why do I say that? Because every dollar you put into this type of policy, it grows, it makes the policy growth first and foremost. It provides a death benefit, that an ever increasing death benefit, the way we structure it, like every time you deposit into the policy, it's an ever increasing amount of death benefit, but it's also building equity inside of the policy. Same way as when you pay down your house and you pay your mortgage, that equity is growing, is increasing. It is the same with this type of policy. It's an asset where it's ever increasing in equity. And then you can harness that equity, you can access that equity and leverage that to acquire more wealth. You don't have to liquidate it. We teach our clients to take policy loans. They take loans out of this asset, like they leverage their capital. They don't liquidate the capital. We want to protect capital, right? So once they leverage the capital that's stored inside of the policy, they can go and acquire even more assets. And the funny part here and the amazing part is that when they're leveraging that capital inside of the policy, it doesn't hinder the policy growth. Like even though they took that policy loan, the policy is still growing. The policy is still generating a dividend. The policy is still providing your family and your business with the peace of mind that comes with a death benefit. And that's also something that we cannot put into any illustration, Rory. I cannot show in any illustration the power and the change of mindset when you know that your family and everything that you're building is protected by a permanent death benefit. Yeah. And if you compare that with something like temporal insurance that you mentioned, the way I explain temporal insurance to my clients is like temporal insurance, you're basically renting the asset. The asset that others are building, you have chosen to rent. The same as you rent an apartment, like you get to enjoy that apartment as long as you pay your rent. You're not growing any equity inside of the apartment, and the rent is due to be increased every couple of years. It's the same for a temporal policy. You can have somebody who's 30 and they have a temporal policy and they're paying 25. Once they turn 40, they're going to pay 50. Once they turn 60, they're going to pay 300. And it gets super crazy as you go up.
3,000, 10,000, 50,000, like, just to give you guys perspective.
It's exponential. It's exponential, right? That cost of insurance is exponential when you don't have the vision to build a permanent asset at your own age, right? When you're young, you can still do something like that. Even if you're 60 or 70, you could still do that, right? But it depends on your means, right?
Absolutely.
Yeah. But
and at the end of the day, this is something people need to understand. Not everyone is guaranteed to get life insurance. You need to qualify.
You buy life insurance with health, not with money. And we know people that have the money.
They don't got the health.
They can't buy it. So this is why I tell you, buy life insurance with health. And even if you're not ready to pull the trigger in something like this and make it permanent, you can start with a temporal one. You can rent that policy. I say rent, right? Because it's a temporal policy. The good thing about starting with a temporal policy is that we can then convert that. Like a lot of the term policies come with convertibility clauses.
Something to ask your agent to make sure.
Like not all of them, but a lot of them. And we make sure, like, I don't sell temporal policy if it doesn't have that.
No.
But what do I achieve with that is that for the clients that are not yet ready to pull the trigger and buy the asset, they can have the temporal one and we don't have to do any kind of medical test if they decide to move with a permanent as long as that temporal policy is still in force, we can convert that into a permanent policy, no question asked. Yep. And there has been the case where people, they're not insurable anymore. They know that they have a health issue, like a big health issue, and they have a temporal policy that's convertible to permanent policy, and they can do that. How crazy is that? It feels like a loophole to me.
It is, and it's a good one to understand because I just did this with a client here this week, Jose.
Okay.
Is convert one of the temporary coverages. She had a term 20 contract with an insurance company here in Canada, and we converted the full amount to a permanent policy.
That's awesome. Okay.
Because she now understood, wow, I am just renting it. What happens if I live till 85 or 90 or 95? Now what? I've been paying into this for X amount of years, and I'm not going to get any value. My beneficiary is not going to receive any value or benefit. That doesn't make sense to me. How can I own it?
No, I know. And
no medicals.
And it's insuring your most valuable assets. I tell people, you have insurance for your house, for your cars, for your motorcycle, for jewelry, for X, Y, and Z, toys, you name it. There's travel insurance, there's insurance for everything. Now, when it comes to your biggest asset, which is yourself, because we are the income producing asset, right? I honestly believe like you cannot quantify the potential of a human life. And within the industry, there's this concept about the human life value, and that's just number concept that the insurance companies have to come up with to put a number to how much they will be able to insure up on your life.
Yeah.
It's just a way of quantifying that in numbers. And I always tell my clients, I want to get you as close as possible to your human life value so that we are taking all the insurance that the insurance company is able to underwrite for. Okay? And a lot of people don't do that. A lot of people don't because I know clients, the insurance company is able to provide up to $5 million in death benefit. And they say, oh no, I don't need $5 million, I just need $1 million. The insurance company says and thinks that you are worth that money. Now you don't think you're worth that money. How crazy that is.
Yeah. You literally have to disclose that I believe that I'm not worth what the number is.
Yes.
It needs to be on writing to protect us.
Yes, because we are telling you, like, this is the amount you're supposed to be insured for. Now, if you say you don't want it, I don't want your spouse to come later and tell me, why didn't you put more money into it? I don't want to have that conversation. But this is a conversation that we have with every single one of our clients. And guys, this is, just so you have an idea, this is stuff we think about. Like, we go to that extent. We think long term. We think about all the details. We think about every possible aspect of insurance to make sure that you properly protect it and that everything you have dreamed of, everything you have worked for, it's protected.
Absolutely.
Yeah.
The insurance need changes over time. See, when you start to pay off your mortgage and your kids start to grow up and create their own life, they're going to have their own insurance need. Yes. But when you look at a lot of grandparents, they don't have a need to protect the mortgage if the mortgage is paid off. But guess what? Who's going to pay the taxes? It goes back to, are you protecting your income and mortgage and making sure that there's enough value on insurance for yourself to protect your kids in the earlier stages of life? But sometimes people forget, what about the need after 65?
Yep. Yeah.
Temporary insurance can't cover it.
It cannot. It could if you can afford it. But we're talking $2,000, $3,000, $5,000 per month.
But now this is where we show value. We show value in education. We show value in making and helping people understand that it's inevitable. We're going to die.
Yeah. And you mentioned mortgage, and something came to my mind right away when you mentioned that house is already paid for. Because there's a lot of families where that house is already paid for. And I don't know if you have seen that, but more and more Canadians are tapping into their home equity after it's already paid to cover part of their retirement income. They call that reverse mortgage. A lot of people don't know what that is. Essentially, a reverse mortgage is you have worked all your life to pay down your house, and now when it comes retirement, you go again to the bank and ask to have the money of your house back to you, and the bank will give you a reverse mortgage. Now this time it's the bank paying you that mortgage, basically. What happens after you pass away? The bank is going to take the house unless you pay that balance down. And this is something I tell my clients, like, think long range, right? You are planning to pay down your house and remain a house owner. You want to be able to tap into that money if you need to. Maybe you don't need to, but if you ever need to tap into your home equity, let's be ready for that, right? So we could build, and we do that, we build a strategy where we are covering your home value with a permanent policy. So when you go in retirement, you have permission to spend.
Yeah.
It's basic.
Again, who's in control?
It's a client in control. Like, we are trying to put them in control. Yeah. Because now, give me that reverse mortgage no problem. Give it to me. I don't care. Like, I have a permanent policy backing it up. And once I pass away, I don't have to leave my children with anything. Like,
yep.
Even though I took that reverse mortgage and I took a lot of that equity, the kids are still keeping the house. How amazing that is.
Yep.
Again, another loophole. It feels like a loophole to me,
yep.
But that you can protect for that and you can access the equity, and the moment you pass away, everything is covered and the kids keep the house. That's mind-blowing to me.
See, these are the type of conversations more Canadians need to be having, and sometimes it's literally just a matter of a quick conversation with
financial advisor.
Us, who understand and isn't so focused on the growth.
Exactly.
How do we keep more money in the hands of the family?
I don't know if I said that to you, but we take like a holistic approach at risk, okay? When we sit down with you, we think, okay, what is your situation right now? Are you a blue-collar worker? Are you a white-collar? What's the risk? How's your occupational risk? If you're a business owner, okay, what's the risk on the business side? What happens if you have to take a 6-month vacation? I call that a 6-month vacation, but it's a joke within the industry, but it's a true reality.
Welcome to reality.
It
happens a lot.
What happens if you're disabled? What happens if you're sick? You cannot take care of business. We think about that. And we bring in the tools to cover for that. We cover short-term risk, medium-term risk, long-term risk. We cover legacy risk, everything.
Yeah.
It's that Freedom 365 that we do out of service. It's disability, it's illnesses, it's estate planning, everything. To make sure that you are in this, I would call that a bubble. It's an awesome bubble that we create for you. So.
Absolutely. It's important for the listeners to know that, again, we already touched on this, but we have the backing of the high-level CPAs. We have the backing of the high-level estate lawyers and tax lawyers.
Exactly.
Like, it's not just us. Like, we're bringing the right team. You bring your team, we'll bring our team.
No, we're just the tip of the spear. Like, we have an army behind.
Yeah.
And that's awesome that we can have that behind us. I will not be able to do this alone, and neither could you.
Yep.
It's that team that makes us what we are.
Absolutely.
So
one more topic I wanted to just discuss on and touch on is life insurance for children to pass on wealth as well. A lot of the time we see people who don't qualify for life insurance, or maybe they have life insurance and the question is, how do we pass on some of this wealth after the tax planning and corporate structures all structured right with the CPAs and lawyers and everyone? How can we maybe use like $1 million baby strategies to start overfunding into your child's life insurance policy so that by the time they're 20, 18 years old or 30 years old, whenever you decide to gift them this policy, it can actually touch 4 generations, Jose, as we know. If the parent or grandparent, let's call it the grandparent, is funding their grandchild's policy, eventually the ownership is going to transfer to the parent, which is their son or daughter of the grandchild. And then eventually, guess what's going to happen? As a gift, maybe for a wedding, or maybe they want to buy a house, or they graduate university, the parent is able to gift them their own policy with their own cash value that their grandparent or great-grandparent started. And then guess who's the beneficiary of this? The great-grandchild.
Yes.
Their kids, hitting 4 generations with the same dollar. How powerful is that?
Yeah, just with the stroke of a pen. It's as simple as that. And we're in the business of selling dollars.
We sell money.
You have said that, right? I honestly believe that. The great Ben Feldman used to say to people, I sell dollars for pennies.
Yep.
And that's essentially what we're doing here. Once you do something like that for a child, and again, in my case, I have sold multiple policies for children. Even my own children have them. This is where we put, instead of funding, full disclosure, I don't do the RESP, because I don't believe it gives enough control to my children. I want them to be able to have full access to the money, no strings attached, to whatever needs they have. And I want them to be able to also make an impact into the next generation. And what a wonderful tool permanent life insurance is to achieve that.
Absolutely.
If you have an 18-year-old, 20-year-old, and you have funded that policy, and that policy is now worth $50,000, for example. Like, that kid doesn't need to go into a bank for his first car. That kid doesn't even need to go to the bank to put the down payment for the first apartment. And that's huge, because if I can have that access to the loans from the insurance company, right? Those are open loans. And those are loans that accrue simple interest. When you do that, you are in control of stopping loan payments anytime. You don't have to explain to the insurance company what's the money for. There's no credit checks. So we're talking like a parallel credit system, if I may say that. But it's not really that. It's your own privatized banking system, where not only yourself, but the next generations will be able to have access to capital without knocking the door on the bankers.
Absolutely.
With the possibility, and this is mind-blowing to me, with the possibility of stopping loan payments. And I'll say that again. Imagine a loan where you can call the insurance company and say, I need to stop my loan payments for the next 3-6 months or the next year because I can't afford it. Or you don't even need to have a reason. Just call and say, I need to stop loan payments. And you don't even have to call. You can call our office and we will do that for you. So let's say a real estate investor, for example, real estate investor. They need access to capital. If they have capital sitting in a structure like this, and they go and take loans out of that policy and go buy real estate. Let's say they're flipping the property and they need to do some renovations. And they're doing the renovations. As they do renovations, if they're into a traditional lender setting, the lenders don't care if that property is ready to be sold or if the market is low. You're going to have to pay their monthly fee.
Absolutely.
But if you're in control of the banking function, it means that you're fully in control. And even stuff like that, you can say, hey, I am invested in this property. It's not ready to be sold or the market is low, but I don't have to deal with coming up with the money to make those loan payments until I'm ready.
That's a challenge a lot of real estate investors have. And this is a solution that can plug that hole in the boat to give them more peace of mind and have more control.
Correct.
Because at the end of the day, we manage risk and we help people and show people how to maintain control and have control of their financial picture,
Exactly.
how they're steering their own ship
Yes.
rather than somebody else on cruise control.
Yeah.
Absolutely.
Okay. Anything you would like to say to the audience, to your people, any final thoughts?
Absolutely. My final thought is encourage all the Canadians and business owners, families, young parents, grandparents, great-grandparents. If you have uncertainties with your current plan and you want a second opinion on what you're currently doing with respect to retirement taxes, and we want to make sure, again, to reiterate the first point, how can we keep the most amount of money in the family and out of the hands of the CRA?
Beautiful.
Feel free to reach out to me. I'd be more than happy to help with me and my team.
Beautiful.
How about yourself, Jose?
Yeah, no, in my case, I just want to say to Canadians that we know the pain points. We know that the CRA, for example, doesn't have the Canadians' best interest at heart. The government doesn't have the best interest at heart. We understand how to help Canadians achieve financial independence, how to break away from those chains of dependence from bankers and the banks. We see the economical landscape and financial landscape with a different set of eyes. I mentioned that before, and that's what we're bringing to you. We bring advisors that understand all those pain points, advisors that are versed in economics, advisors that are well versed in capital protection and estate protection. And that's the bulk of what we do. I would just advise anyone that wants to know more about our organization. You can reach out to us at austaris.com. And thank you.
Rock and roll, man. Thank you very much, Jose. I appreciate it. Thank you for your time.
Okay. Goodbye.
Take care, guys.